Now that we know about the cost of the asset, we'll look at how we calculate and record amortization. But first, as a reminder, back from our adjusting entries chapter, what is amortization? That's what we'll start with. So amortization is defined, you can see there, it's the allocation of the cost of property, plant, and equipment, except for land, less any salvage value over its useful life. So we know that property, plant, and equipment, these items have several years of life. So they last for multiple years. But each year we're using up some of that benefit. So each year as we use the benefit and as those assets are helping us to generate revenue in our business, we need to record or move a portion of that cost from the balance sheet, from the asset to the expense. That is amortization. So we're matching the asset's cost, moving it to an expense, and matching that against the revenue earned by the asset, as well as moving some of it as we use the benefit up. It should be noted that amortization is not a cash outflow. So it's not an expense that we're paying for cash. We paid the cash when we actually bought that asset. So not a cash flow, just an accounting item to move the cost into the expense. And it's also noted here that amortization could also be called depreciation. So they mean the same thing. When we looked at amortization earlier, and as we're going to look at it again, it's based on the cost of the asset, the estimated useful life, as well as the estimated residual value. We've talked about the cost in the last video. Now we can see that the estimated useful life, it's the length of the service period that that asset is expected to use or to last. So when we looked at this earlier in our adjusting entries chapter, we just looked at the straight line method. And in that case, we looked at the estimated useful life in years. But the other methods we're going to see is you could also look at it in terms of units of output. So maybe if it's some sort of manufacturing equipment, how many units will it be able to produce and output before it's ending, or in kilometers if it's a vehicle. So the estimated useful life could be in years, or it could be in these other units of output. The estimated residual value or the salvage value, same name, same thing, different name, same thing. This is the expected cash value at the end of its useful life. So we talked about if you can sell it for scrap parts or get some sort of recycling at the end and you get some sort of value, or if it might just no longer be useful to you in your business, but you can sell it to someone else to use outside that business. So whatever cash value you think you're going to receive at the end of its useful life, that's that residual value. So we take this all into consideration and use it to calculate our amortization that we record each year. Now it should be noted, as you see at the bottom here, that we start with the cost and we subtract the residual value, and that gets us to what is called the amortizable cost. So we're not going to put this full cost into the expense. We're going to put only the amortizable cost. So that means that we stop amortizing or stop recording this expense in the year when we get to the residual value as our book value. So we'll talk about this in the examples, but that's where you stop. So the amortizable cost is the cost minus the residual. So there are three methods of amortization that we're going to look at. We've covered straight line earlier. We'll go over it again as a review, and then we'll also look at units of production and declining balance. So the straight line method, or the reason why there's these three different ones, is because assets get used up and help create revenue in different ways. So the straight line method it's going to be allocating an equal amount of amortization each year of use. So we looked at the number of years, or the amortizable cost divided by the useful life in years, and each year we allocated the same amount to the expense. So this is used for a company or for a business or an asset that is creating revenue equally over its life. When we look at units of production, we're now allocating a fixed amount per unit of output. So for example, if it's a truck, we would amortize it based on the kilometers that were driven in that year. That's the unit of output. So now instead of years, we're looking at these units of output. We figure out a fixed amount per unit, and then however much that asset is used in that year, we multiply it by that. So this method is good for assets that might sit idle for a period of time. And therefore, if they're not being used, they're not creating revenue, and they're not giving any benefit. And they're also not being used up. So if that's the case, and you might have this idle time, units of production is better because it amortizes it based on how much it's actually used in that period of time. The declining balance, here we'll see that this allocates a greater amount at the start of the asset's life. So right away we have a higher expense, and then each following year we have a lesser amount. So this method is useful for an asset where it's more efficient and productive right at the start and helps us generate more revenue, but then as the time goes on, it gets less efficient and less productive. So less revenue and therefore less expense. So the different methods for different purposes, we'll go through all three of these in the next videos.